What if the biggest Bitcoin story right now has nothing to do with a halving, nothing to do with a new bull run everybody's screaming about, and nothing to do with some influencer's chart with 3 arrows drawn on it? What if the real story is happening somewhere much quieter, in Washington, and inside the offices of the largest asset manager on the planet? Because right now, something strange is lining up. Trump has spent the better part of 2 years pushing crypto toward the center of American financial policy, and at the very same time, BlackRock has quietly built one of the biggest doorways institutional money has ever had into Bitcoin. 2 enormous forces, moving roughly in the same direction. And that raises a question a lot of people are afraid to ask out loud, because it sounds almost embarrassing to say, could $200,000 Bitcoin be less of a meme and more of a mechanical outcome of what's already in motion? Stay with me, because before we get anywhere near that number, there's something you need to hear first. Quick and honest disclaimer before we go further. Nothing in this video is financial advice. I'm not your advisor, I'm not your accountant, and Bitcoin remains a volatile, speculative asset that can lose value just as fast as it can gain it. This video is here to walk you through the mechanics, the data, and the arguments on both sides, so you can think for yourself. What you do with that information is entirely up to you. All right, with that out of the way, let's actually dig into this. Here's the part almost nobody tells you up front. As of this week, in mid-August of 2026, Bitcoin has been trading in the low $60,000 range, closing around $63,400 just yesterday. Not the $100,000 plus levels a lot of recycled online content still assumes. Bitcoin actually hit its all-time high back in October, and it has spent the month since pulling back and consolidating, currently sitting more than 40% below that peak. So let's be honest about the math before we go any further. $200,000 from here isn't a modest bump. It's roughly a 3 times move from where price sits today. That's a very different conversation than Bitcoin just needs to double. And yet, comment below and tell me, are you surprised the price is actually lower than most headlines make it sound? Because that surprise right there is exactly why this story matters. People are debating a 6-figure target on a coin that's currently trading closer to 60 than to 160. That gap between headline hype and where the number actually sits is the whole reason this needs a clear-eyed breakdown. This is also where the real story starts, because the $200,000 question was never really about the number. It's about whether the machinery behind Bitcoin has fundamentally changed. And that machinery has a name, 2 names actually. For most of Bitcoin's history, the buyer was a retail trader, somebody opening an exchange account at midnight, setting up a wallet, worrying about private keys, praying they didn't fat finger a withdrawal address. That buyer profile has been quietly replaced. The new pathway looks completely different. It runs through a spot Bitcoin exchange traded fund, into a financial advisor's recommendation, into a pension allocation, into a wealth manager's model portfolio. And BlackRock's fund, called IBIT, sits right in the middle of that pipeline as the dominant player. Here's a number that tells the story better than any headline could. Over 5 trading sessions at the start of August, US spot Bitcoin ETFs pulled in roughly $853 million combined. BlackRock's IBIT alone accounted for about $693 million of that total, somewhere around 81% of everything that came in. 81 cents of every dollar landing in one single fund. That's not a coincidence, that's dominance. Total assets sitting inside US spot Bitcoin ETFs now sit close to $79.5 billion, which works out to roughly 6% of Bitcoin's entire market capitalization. Since these products launched back in early 2024, cumulative inflows have topped $52 billion. What BlackRock effectively did was strip away every piece of friction that used to keep traditional money on the sidelines. No custody headache, no private keys to lose, no compliance nightmare for a pension fund's legal department. BlackRock turned Bitcoin from something you personally had to go buy into something a financial institution can simply allocate toward, the same way it allocates toward gold or bonds or an index fund. But hit like, if you already knew ETFs existed, and be honest, did you know one single fund was responsible for the majority of the entire category's flow? Because that concentration is the part almost nobody's talking about. And here's the twist. BlackRock isn't actually the most interesting part of this story, because even a company managing trillions of dollars cannot manufacture demand out of thin air. Somebody still has to decide Bitcoin belongs in the portfolio in the first place, and that decision runs straight through Washington. This is where we get into Trump's role, and I want to frame this correctly, because this isn't about politics, it's about mechanics. Trump has positioned his administration as aggressively pro-crypto, pushing for the United States to be treated as a hub for digital asset activity rather than a place that regulates it into hiding. That's shown up in several ways. Friendlier regulatory posture from agencies, public statements around strategic Bitcoin reserves, and continued pressure to pass clearer market structure legislation for digital assets. One piece of legislation, often referred to as the Clarity Act, has actually become tangled up in the $200,000 narrative itself. Some forecasts tied to that bill's passage have cited that price target directly. But, and this matters, reporting has also been clear that the political path for that bill remains genuinely uncertain, and passing odds have been described as low. This isn't a done deal sitting on someone's desk waiting for a signature. So here's the honest framing. Trump hasn't personally created a $200,000 Bitcoin. Nobody can wave a hand and make that happen. But policy direction absolutely changes how many institutions are willing, or even legally permitted, to participate in an asset class in the first place. Stay with me here, because the next part is crucial. Policy doesn't move price directly. Policy moves permission, and permission moves capital. And capital is the only thing that has ever actually moved Bitcoin's price. Quick question for you while we're here. Comment below, are you someone who trades based on policy headlines, or do you tune all of that out completely? I'm genuinely curious which side of that line most of you fall on. Let's strip this down to something simpler than politics or ETF tickers. What actually moves the price of Bitcoin? Not headlines, not tweets, not a hopeful comment section. Capital. Bitcoin's total supply is capped and grows more slowly with each passing year, thanks to a fixed issuance schedule. If demand rises faster than the pool of willing sellers grows, there's only one place for that pressure to go. The price has to adjust upward to find a new balance between buyers and sellers. Now stack the sources of new capital on top of that scarcity. ETF flows, corporate treasury purchases, growing interest from sovereign wealth funds exploring digital asset exposure, and slowly increasing allocations from wealth management platforms that used to avoid crypto entirely. Here's where the math starts to actually get interesting, so stay with me. The real question was never how many people want Bitcoin. The real question is how much capital is competing for each available coin, because it doesn't take universal belief in Bitcoin to move its price significantly. It only takes a small slice of an enormous global capital pool deciding to show up. And how is the weather where you're watching this from, by the way? Drop it in the comments. I always like reading where everyone's tuning in from, whether you're catching this on your lunch break or in bed at midnight scrolling before you sleep. Okay, back to the capital question, because this next part builds directly on it. Here's what makes BlackRock's role bigger than just another ETF issuer. Its real power isn't the fund itself. It's the distribution network sitting behind that fund. Think about the chain. BlackRock to thousands of financial advisors, to millions of individual client portfolios, all through a single regulated product that looks, on paper, exactly like buying shares of any other fund. That turns the ETF into infrastructure, not a speculative side bet anymore, a plumbing system that quietly connects Bitcoin to the entire traditional wealth management industry. Here's a strong way to think about it. BlackRock doesn't need to convince all of America to fall in love with Bitcoin. It only needs to make owning Bitcoin easy enough that advisors stop hesitating to recommend a small allocation. And even a tiny percentage allocation pulled from the more than $100 trillion sitting across traditional global asset pools represents an enormous amount of fresh dollar demand, chasing a supply that simply cannot expand to meet it. So subscribe if you want the next part of this breakdown, because this is exactly the mechanism behind the number everyone keeps arguing about. Let's not say Bitcoin will hit $200,000, because nobody honestly knows that. Instead, let's ask what would actually need to be true for that number to become realistic. Starting from roughly $63,000 today, reaching $200,000 means a move of a little more than 3 times current price. That's a meaningfully bigger ask than the just double it framing you'll see thrown around elsewhere online. So break it into scenarios, because that's how you actually stress test a number instead of just believing it. Scenario 1, moderate institutional adoption continuing at a steady pace, similar to what we've already seen this month. Scenario 2, an acceleration in ETF inflows, building on that 81% BlackRock-driven streak we already discussed. Scenario 3, a shift in macro liquidity conditions, meaning falling interest rates and easier financial conditions that push investors back toward risk assets. Scenario 4, an actual policy catalyst, meaning something like that Clarity Act legislation genuinely passing, not just being discussed. Scenario 5, a supply-side shock, where long-term holders continue refusing to sell even as demand climbs. Here's the part that should genuinely make you pause and think. What happens if more than one of these scenarios lines up at the exact same time? That's not a guarantee, but it is the scenario that turns a 3 times move from being a fantasy number into something worth taking seriously. Comment below. Out of those 5 scenarios, which one do you think is the most realistic to actually happen this year? I want to see what the community thinks. This next piece is the one most crypto content creators skip entirely, and it might be the most important part of the whole video. So stay with me here. Bitcoin does not exist in isolation from the rest of the financial system. It trades inside the same liquidity environment as stocks, bonds, and every other risk asset on Earth. That means Federal Reserve policy, real interest rates, the overall supply of dollars moving through the system, and broader risk appetite across markets all directly affect how aggressively investors are willing to chase an asset like Bitcoin. Here's the blunt version of that truth. Bitcoin can have the most compelling story in the world. Institutional adoption, political tailwinds, scarcity, all of it. But if liquidity is tightening and money is genuinely getting harder to borrow, markets can still punish the price anyway. Recent inflation data has actually come in cooler than expected, which has kept alive hopes of eventual rate relief, but nothing there is settled or guaranteed. Now flip it. If liquidity conditions loosen at the same time, institutional demand is already sitting there waiting. That's the environment where things can move a lot faster than anyone expects. This is where it gets really concerning for anyone treating Bitcoin like a sure thing, because liquidity is the one variable in this entire story that neither Trump nor BlackRock fully controls. I want to be fair here, because a video that only tells you the upside isn't actually helping you. So let's spend a few minutes tearing apart the bullish case. Here's what they're not telling you in most of the hype-driven content out there. Spot Bitcoin ETFs are not a one-way street. During the first half of this year, U.S. spot Bitcoin ETFs actually recorded around $5.5 billion in net outflows, their first negative half year since these products first launched. Year to date, even after the recent rebound, the category is still sitting at a net outflow of roughly $4.5 billion. And just this week, that same inflow streak we talked about earlier reversed. ETFs recorded around $144 million in outflows after 5 straight sessions of gains. BlackRock itself responded by lowering the minimum threshold for large in-kind redemptions from $25 million down to just $1 million, making it easier, not harder, for big holders to pull Bitcoin out through the fund. Other real risks sitting on the table right now include a broader economic slowdown, a sudden regulatory disappointment if that Clarity Act legislation stalls out completely, leveraged positions unwinding fast during a sharp drop, and simple institutional profit-taking after any strong rally. There's another uncomfortable truth buried in here too. The same institutional pipeline that can push billions of dollars into Bitcoin can also pull billions of dollars back out, often much faster than retail selling ever could. So hit like if you appreciate a channel that actually shows you both sides instead of just chasing the hype for clicks. Here's a psychological twist worth sitting with for a second. Institutionalization brings real benefits: legitimacy, deeper liquidity, and far easier accessibility for everyday investors. But it also quietly builds something else: more centralized market infrastructure sitting on top of a technically decentralized asset. Bitcoin, at the protocol level, remains as decentralized as it's ever been. But exposure to that asset is increasingly routed through centralized financial vehicles that behave according to entirely traditional financial incentives. That creates two forces pulling in opposite directions at once. On the bullish side, legitimacy, liquidity, mainstream accessibility, and genuine institutional adoption. On the risk side, concentration in just a handful of large funds, market maker dynamics nobody outside finance really understands, and growing correlation between Bitcoin and the broader traditional markets it was originally supposed to be an alternative to. Here's a line worth remembering. Wall Street may be turning Bitcoin into a mainstream asset class, but Wall Street has never once held an asset out of emotional loyalty. It holds positions because the spreadsheet says to hold them. The moment that spreadsheet changes, so does the position. Now let's connect these two storylines properly, because this is the part that ties the entire video together. Trump's contribution to this story is policy direction, regulatory legitimacy, and a general political tailwind for the entire crypto industry. BlackRock's contribution is capital distribution and institutional grade access for everyday advisors and their clients. And Bitcoin, underneath both of them, remains a scarce fixed supply digital asset that cannot simply print more of itself to meet rising demand. Put simply, policy opens the door. BlackRock builds the doorway through the ETF structure, and capital is the thing that actually walks through it. But here's the honest catch, and I promised you both sides tonight, so stay with me for this last piece. Even with policy support and institutional infrastructure both lined up, there's still one ingredient missing. And without it, Trump and BlackRock together might genuinely not be enough to get anywhere near $200,000. That missing piece is liquidity. We touched on it earlier, but this is where it actually completes the picture. Institutional demand, combined with favorable policy, combined with genuine supply scarcity, that's a powerful setup on paper. But liquidity is what determines how aggressively investors are actually willing and able to chase risk assets in the real world. If liquidity conditions improve and ETF demand keeps climbing, while available Bitcoin supply from long-term holders keeps shrinking, that combination becomes genuinely asymmetric. Not guaranteed, not a promise, but potentially explosive if all three line up together. That's the honest version of the $200,000 thesis. It was never about one tweet. It was never about one politician's approval, and it was never about one single ETF issuer's inflow numbers. It's about a genuine collision of capital, policy, liquidity, and scarcity, all showing up in the same window of time. Before we wrap up, here's something practical you can actually use, instead of just walking away with a number stuck in your head. Signal 1, ETF flows. Are institutional inflows accelerating like they did in early August or reversing like they just did this week? Signal 2, policy. Does Washington keep moving toward genuinely clearer crypto regulation? Or does that Clarity Act legislation stall out the way its current low odds suggest it might? Signal 3, liquidity. Does the broader macro environment turn more supportive for risk assets, or does it stay tight and cautious? If all three of those signals start flashing green at the same time, this conversation stops being speculative and starts becoming a genuinely serious one. Share this with someone who keeps asking you if Bitcoin is actually going to $200,000, because now you've got the real framework to answer them properly instead of just guessing. So, did Trump and BlackRock just quietly confirm $200,000 Bitcoin? No. And anyone telling you it's guaranteed is selling you certainty that simply doesn't exist in any market, let alone one this volatile. But something else, something arguably bigger, has genuinely happened. Bitcoin is no longer sitting around waiting for Wall Street to decide whether it deserves a place in the financial system. Wall Street is already building permanent infrastructure around it, and Washington is increasingly shaping the rules that infrastructure will have to operate inside of. The real question isn't whether Bitcoin can technically reach $200,000 from here. The real question is what happens if enough institutional capital decides it simply cannot afford to sit on the sidelines and miss the move. $200,000 Bitcoin, impossible or inevitable? Comment your honest answer below. I read every single one. And if this kind of breakdown is exactly what you come here for, subscribe to the Wealth Continuum, because next week we're going deeper into the exact capital flows that could decide whether this thesis actually plays out or quietly falls apart. I'll see you in the next one.